Welcome to Trading Day. I'm Matt Scooby. Let's get to some stories that we're following in the BNN Bloomberg newsroom. Prime Minister Mark Carney calling on the Trump administration to have closer cooperation on aluminum, manufacturing, and critical minerals. He made his pitch at the Economic Club of New York today. It comes as the U.S. and Mexico begin formal talks on changes to the Kuzma trade agreement. Carney says Canada has the most valuable commodity.
We are also making progress because our reputation as a reliable, predictable partner has rarely been more valuable in a world where transactions are replacing relationships. We're blessed with many commodities.
The Bank of Canada says the country's financial system is doing well despite multiple challenges. It says U.S. tariffs, the war in Iran, and AI-related risks all pose threats to financial stability. The central bank also warning of rising valuations of financial assets, as well as the increase in global sovereign debt issuance. The OC Deputy Governor.
The main concern for both households and businesses is a geopolitical or economic shock that leads to a deep recession and a sharp rise in unemployment. Canada's large banks have become more resilient over the past year, with higher profitability and healthy capital buffers. They have also set aside additional funds to absorb potential loan losses. This positions them to support the economy and financial system, even in a severe downturn.
Oil prices are lower on news of a renewed push to end the war in Iran. Axios reporting that Iran and the U.S. have reached an agreement, though, on a truce. The report says the truce is for a 60-day extension of the ceasefire and for negotiations to start on Iran's nuclear program. U.S. President Donald Trump still needs to approve those terms. The report comes after the U.S. carried out airstrikes on an Iranian military site overnight. Let's have a quick check on the markets now, shall we? Here, midday two so far. The TSX up on the day today, led to now technology, base metal sectors are helping it climb to late morning here after a slow start and sluggish start earlier in the day. Meantime, south of the border in the U.S. also, again, in the green, at least for right now, too, pushing to some more record highs here in the last little bit for the S&P 500, along with the Dow Jones, too. As you can see, a little bit of green there on your screen. So watching those, at least for now, some big profits for a number of companies today. That is certainly buoying, for now, the markets that we have seen oil claw back a little bit of the losses that we did see as that yo-yo continues here this week. We're also going to show you, too, at least for now, the TSX Bank Index, too, as well. We talked about the Big Six. They beat earnings expectations pretty much right across the board this week, with most raising its dividends. What's that telling us about the health of the Canadian economy, though? Here to provide an in-depth analysis on this and more is Jillian Stovall-Rivers, Senior Wealth Advisor and at CI Asante Wealth Management. Jillian, thanks for being here.
Thanks for having me.
Let's talk about the banks before we get into the nitty-gritty of it. Overall, yesterday, today, right across the board, beating profit expectations too. Give me your big takeaways here of what we've seen in this news from the last couple of days.
I think there's really two stories going on here. The first is obviously banks beating expectations, able to raise their dividends on large, and that signals to the asset owners that everything is well and good. But at the same time, a lot of these banks, if not all of them, have higher capital reserves in place just in case something should happen, just in case we reach that point when maybe some of those mortgage resets happen at a time when interest rates maybe have to go the other way because of inflation concerns. And that's a signal about those loan loss provisions that's a little bit darker than maybe those higher dividend payouts might signal. Yeah, and we know when that's been coming for a little bit. The banks, I think, have known too, as they've been keeping, putting that money aside too as well. CIBC not increasing its dividend. Is that a concern at all for any investors, at least at this point? I don't think so. Okay. I think you could go either way, and I think that the potential for them to increase their dividend going forward still exists. The bigger issue is this two-pronged economy where you have the asset owners benefiting from dividends, but then you have the people who aren't yet asset owners who are at risk of suffering because of increase in interest rates, increase in cost of energy, all of those things hitting at exactly the same time. And it's nice to see that the banks are prepared to take care of the asset owners as well as the people who are their biggest lender or biggest borrowers.
Yeah, and I think it's, you talk about that K-shape, and it really has been the concern here and where we are going as well. When we talk about that allocation for debt too, are some of them have cut? Did I see that too? At least have we seen RBC maybe cutting some of that, like the little bit of cash that we had, or not?
I don't think so.
Okay.
I think we still need to have those. And the increases over the reserve requirements aren't significant, but they're enough to suggest that we might need to do some workouts at some point. And I'm hoping that is the case, that we find a way to use the banking system in order to increase the financial literacy, in order to allow people to stay in their homes. At the end of the day, what we'd really like to be is a nation of asset owners. And the home is really the number one way in which most Canadians can own a home. If that gets taken away from them because of a lack of a workout provision by those banks, then unfortunately we're stepping backwards instead of forwards.
And then ultimately, too, and along that same line, bigger picture here, Canadian economy, just in general, to what the bank's profits and what we're seeing from the earnings for the last couple of days, what it speaks to where the economy is at. What are your thoughts?
Well, I mean, the biggest risk right now that is unknowable is this, as you mentioned earlier, the war in Iran. If we are able to scale that back and we are able to find a way to bring energy prices back down, then we are in a place where maybe inflation doesn't take such a foothold, because that's already driving a lot of decision making for scarcity mindset homeowners, scarcity mindset Canadians who might not have anything more than 30 days ahead of them that they can see. And that scarcity mindset tends to breed poor financial decisions. If we can extend that out by reducing that cause of inflation with the price of energy, then we give Canadians a better shot at building wealth, and we give Canadians a better shot at existing in an environment of hopefully moderate interest rates instead of higher interest rates. Yeah,
and hopefully some good news today too. We'll see. We've had the back and forth continually on what's going to happen with the conflict in the Middle East too, but reports that a possible truce has been reached. I'm curious, and maybe just pivoting just a little bit about Mark Carney and the Prime Minister too as well. We have seen his pitches across globally too, now in New York with it when it comes to Americans, and we have this Kuzma review looming.
Yes.
It's not a hard deadline on July 1st, we get it, but it certainly seems as Mexico is starting official and negotiations today with the United States, Canada lagging behind, but Canada also, I think, playing a little bit more hardball right now, and that Mark Carney is not just going to give anything up or be there. So what does his message today indicate to you for where the government might be at in continuing to look for this investment from south of the border that is not necessarily trade related, and the benefits that Canada has seen, at least so far, in diversifying the trade that's happening globally?
Today's a good example of something can be brilliant and scary at the same time. I think it is a brilliant move to be down there and telling these stories and opening these dialogues with private investors. And if there's something that private investors love, is really two things. They love lots of things, but smart money loves growth and profit. Smart money also loves predictability and security. And I think that message of being this moderate power anchor in the world that is open for business to be able to bring private wealth and private investment into Canada in order to take advantage of our resource sector at a time when not only the energy, but also all of our minerals, as well as our resources related to the AI build out, are extremely valuable. And if we can be a face and voice of that to the world and represent ourselves as open for business, that's a whole other angle on those trade negotiations that's extremely powerful.
Yeah, and it's funny that you mentioned that too, because it feels like the benefits and the offshoot benefits of that. Yes, we talked about the consumers and how they're feeling the pain right now too.
Yes.
But you look at the other end of that spectrum too as well, and the money that this country is making now too as a result of the higher energy prices too when it comes to the oil and gas companies, and that we're seeing. And you talk about the AI build out that is slowly starting. Just the amount of investment, the potential and the capability is there.
Yes. And I bet you nobody comes on the show and talks about Charles Dickens, but this is very Tale of Two Cities, right?
Yeah.
This is very Tale of Two Cities. And I think the objective here would be to try and democratize the ownership and the benefit from those investments in a way that a Canada Strong Fund can make it so that all Canadians can become asset owners in some way, because fundamentally our brains operate differently when we're in a position of asset ownership instead of being beholden to the asset owner.
Very true. It's going to be interesting to see what happens. Jillian, thanks so much for being here.
Great to be here. Thank you.
Jillian Silva-Rivers, Senior Wealth Advisor at CI Asante Wealth Management. Up next, power sports equipment maker BRP cuts its full-year profit outlook and says U.S. tariffs will weigh on results. We're going to have more details on that after the break. BRP posted weaker first quarter earnings. Revenues were up nearly 30%, but BRP expects U.S. tariffs to weigh on its performance and has cut its profit outlook for the year. For more on the numbers, we spoke with Jonathan Goldman, analyst, diversified industrials at Scotiabank.
If we just rewind, a bit, what happened is, I guess 6 weeks ago at this point, BRP withdrew their guidance from the year. They suspended guidance, and that was because of the change to S-232 tariffs. Previously the company was only paying tariffs on the content of the steel and aluminum in their units, and then all of a sudden overnight they were subject to pay the 25% tariff on everything. So they withdrew guidance, and at the time, about 6 weeks ago, they said it would be a $500 million hit to EBITDA. Today, and to their credit, they reinstated guidance and they've cut that bill down to only about $300 million. So probably better than feared, probably better than anyone expected, if they expected anything. Pretty impressive what they did so far.
Do we know why the change, that drop? What is that, a 40% drop? Or about a 40% drop, I guess?
Exactly. So the original hit was a 40% drop to earnings. They've cut that down to only a 25% hit to their earnings. A bunch of different factors. One, the industry has been better than they thought it would be. The seasonal demand for snowmobiles has been stronger. There was a better promotional environment than they anticipated. The other off-road products are doing well. But the other piece that's truly remarkable is they found an incremental $200 million of cost savings and other initiatives in the business. This is overhead reductions, nominally raising prices by less than 1-2%, and some other efficiencies to offset that tariff bill. So pretty amazing that you could just look around in 6 weeks and find $200 million of savings to offset that bill. So the management team, the entire business definitely deserves a lot of credit here.
Now, does that seem extreme, or does that tell you that maybe the company wasn't running as tight as it should?
Drastic times call for drastic measures. What's amazing is they took these actions and they haven't impacted the long-term profitability or outlook for the business. BRP is a diligent, well-run business management team. They're always looking at innovation. So they haven't cut any costs or corners here that would impair the long-term fundamentals. I think they squeezed out everything they possibly could, maybe delaying some in-house projects or development, looking for ways to save here. But I don't think it was run any tighter than it should have been. It's just, drastic times, people will find whatever they can do to kind of find some savings there.
Okay, and CUSMA, that's been the center point for them. The negotiations are coming up. What are they expecting? What are they bracing for? Or they kind of have two paths laid out for themselves?
It's the billion-dollar question. Originally it was just USMCA, right? And then we have this separate section piece called S-232. So on the earnings call today, the company said that, their going-in assumption is we'll see a convergence between those two pieces of legislation and trade policy, meaning, if there's some sort of resolution on USMCA and we restore, what actually is supposed to be a free trade agreement, we could see the same thing sort of resolve itself on S-232. So I think any sort of negotiations, any sort of talk, that's the next catalyst for the company, for the stock. Obviously, it would help visibility. I think all parties, on all sides of the border and the three countries are looking for some resolution. I think everyone has come to the realization, lack of free trade doesn't help anybody. Sure, there's always things that can be improved and we could repurpose manufacturing and, and protect some industries. But I think everyone understands that it's to everyone's benefit to come to some sort of agreement.
And are you surprised at the increase in sales? We've talked about a lot of people seem to be struggling, but then we see this from essentially in many ways recreational vehicles, or were they stronger commercial sales for them?
That's a really good question, right? So you hit the nail on the head, right? The economy is not great. It's not like people are running. You see the consumer confidence numbers to go out and buy things. So I guess that was surprising on the demand has been more resilient than we expected. Part of that is seasonal, really strong snowmobile season. The other piece to it, and you probably know this as well, is DEW skews more recreational than utility or commercial vehicles. So what's surprising here, or I guess maybe we should have known, is DEW's products tend to target a wealthier household, a more affluent household, and they've been holding in relatively well. I think I've heard from one corporate that you're going to need gas prices to go much higher than $4 a gallon before people stop buying $800,000 units, second cars effectively. So that's kind of been the story here. High quality units, performance-based, wealthy households, and they've been resilient and they've been buying these new products, which have been actually really well received, the new models they've released.
They have an $800,000 recreational vehicle?
Not that much, I think it could go up to 100, maybe 120, not that high. It used to be in the boats, but they tend to be in the $35,000 range and all the way down. Yeah.
And so you have it at 80. What did I do? Yeah, $80 for the stock. Where any changes on that, or are you still solid on that?
We're still reviewing our estimates. What I would say is what the results do today is they add more clarity to the story. If you looked at consensus going in, I think the range of estimates were anything from 700 million of EBITDA all the way to 1,200. So wide range. No one knew what to expect. What this does is it really solidifies the bill, at least in this point. Obviously, things can change depending on what social media comes out. But at least now we have something to set a peg to, and we can kind of forecast earnings. And, any time when you have more visibility and more certainty on forecasting earnings and free cash flows, it has positive implications for the stock and valuation, which investors prize.
That was Jonathan Goldman, analyst, diversified industrials at Scotiabank. Well, coming up, Snowflake shares are surging after a strong quarter and a major deal with Amazon. We're going to have a look at how sustainable the move is next. Snowflake rallying sharply after strong results and a $6 billion cloud deal with Amazon as the company leans further into AI-driven growth. Investors clearly taking notice. But does this mark a real turning point for the company? Let's bring in Brooks Eidlet, Senior Equity Analyst at CFRA Research. Brooks, thanks for being here.
Hey, thanks for having me on.
Stock clearly up sharply on this today. One of the big movers, too, especially south of the border. What exactly is behind this? What is the market rewarding, I guess we should say?
So I look at this in two parts. First off, Snowflake is a stock that's been showing decelerating revenue growth for the past, since its IPO, basically in 2021 or so. And so today they came out with really impressive guidance. They're looking at product revenue growth of 31% in fiscal year 2027 from their previous view of 27%. So not only is that a big increase from their prior view, but it also implies actual growth in revenues this upcoming year. And then the backside of that is that since early February, we've seen a ton of selling pressure in the software space. And investors are really looking to which companies are set to benefit, become net beneficiaries of the AI trend. And Snowflake clearly seems to be one of those companies. And then just to pile on to that, the second part of what's driving the stock today is they announced a big $6 billion compute purchase deal with their big AWS, their major cloud partner. That more than doubles their prior commitment to purchase a cloud space at AWS. And so that's a big move in terms of confidence, their demand projection. It also implies some volume-based pricing discounts and some product efficiencies going forward. So really just confident moves showing Snowflake as a beneficiary and not a competitive risk here for the AI trade.
Yeah, okay, so I want to talk about AWS in just a second, but let's start with the AI too. And what indications do we have that it is driving necessarily or could be driving here soon real revenue growth? Do we know?
Yeah, so up front, the majority of their guidance raise was driven by the inclusion of consumption patterns for their new Cortex Code product. So that helps companies design AI agents. It's primarily data agents from the Snowflake side, but that's seen a ton of traction. They've got their Snowflake Intelligence platform, which is sort of the business user side of that Cortex Code builder platform there. Just tons of traction qualitatively, quantitatively. We've seen just growth slowly accelerate here in prior quarters, and this is the biggest guidance raise we've seen yet. And so it's just overall performance driven by what's been pegged to just specific AI products that are coming out at a quick rate. We also have customers that are signing up for the AI products or are using Snowflake AI products. Nearly all customers are now doing that, which is, it more than doubled, I think, in the prior year, the total customer count there. So I'm just strong on a lot of different metrics there.
Yeah, I was reading about that significant increase, too, in the AI products in particular. How does it now stack up to, against, Databricks and the other hyperscalers? Where is it now, at least at this point, or do we need to wait a little bit longer to get a better idea?
Yeah, I think Snowflake is clearly a leader in the space. I think Databricks, you could place them in there as well. Databricks not being public, it's harder to read through and see some of how their metrics are trending. But yeah, Snowflake continues to show themselves to be a beneficiary as this wave continues to rise. I think you're going to continue to see better prints coming forward. And just all the partnerships that they have, the Anthropic partnership, OpenAI, Google, Azure, AWS, they're clearly tied to some of this upward momentum in the space.
Okay, let's go back to the AWS deal. $6 billion, clearly significant too. It sounds like these two are pretty connected. There's going to be chips involved too as well. But just take us through, at least for now, how does that change this growth trajectory too with the signing of that deal?
Yeah, I mean, I really look at it first off of what it signals. It's, to more than double your prior agreement when business was already booming. AWS is already where they host most of their computing workloads. It shows a ton of commitment to that space. It locks up compute capacity for them to be able to provide for customers. They're a top customer or one of the top customers for AWS now in terms of their workloads. At the same time, I think with tokenomics remaining a question, the ability to lock up sort of a lower price per unit for compute for customers is going to be an advantage going forward. And I think you see the AWS commitment as well to the Snowflake ecosystem. They're going to see product development on a joint basis, efficiencies improving as these two work together on their infrastructure. And I think it just all signs point up for the two.
Are there any additional risks, though, to this deal that we might see that maybe investors need to be aware of?
I mean, you're committing a lot to a particular hyperscaler, to that ecosystem. I think I would see perhaps more risks if there wasn't a ton of history here. If the two hadn't been working together for a while and they were just hoping to secure cloud capacity by any means necessary, or just lock down a significant partner. But with Snowflake, you've got relationships across all three major hyperscalers. I think that this is just more of a sign of demand than it is a sign of, risk and just locking down compute right now.
You touched on it earlier, too. They raised guidance as well. How conservative or aggressive does that outlook in particular look to you with what they did?
It's tough to say. I think Snowflake is typically a conservative guider. They guide based on exhibited consumption patterns. And so, a big impact here was their inclusion of that Cortex Code product that went GA in February. So they weren't previously guiding much from that. And then when they released it and saw a ton of traction there, they were able to sort of project that forward, I should say. But I continue to think they're going to guide conservatively, that they are guiding conservatively, and that as AI traction continues to beef up, that's only going to improve. I mean, the selling pressures in software and services have all sort of been based around this idea of workloads migrating to agents and away from human labor forces. And if that happens, as the bears sort of fear it might, that's only going to benefit underlying consumption on the data platform for Snowflake. It's only going to benefit agentic tool usage, which will allow them to then project additional increases for guidance further on. And so it seems to be working out well for them.
Brooks Eilert, Senior Equity Analyst at CFRA Research. Brooks, appreciate your time today. Thank you.
Thanks for having me.
Well, still to come, Canada's labor market is holding up, but not evenly. We'll look at why and where some of the concerns might be coming up after the break. Royal Bank saw better than expected second quarter results, helped by growth across its major businesses and lower than expected loan loss provisions. Net income rose 26% from a year earlier. RBC also raised its quarterly dividend and announced plans to buy back up to 45 million shares. TD Bank posted second quarter earnings that beat analysts' expectations as it pointed to improving momentum in its U.S. operations. Total net income reached over $4 billion, and the bank also increased its quarterly dividend. TD highlighted the progress in strengthening its anti-money laundering controls following recent regulatory scrutiny south of the border. And the union representing workers at Canadian Pacific Kansas City has delivered a strike notice. The organization says about 300 track signal workers will walk off the job Sunday. It says the workers are concerned about wages, work-related experiences, and work-life balance. CPKC says railway operations will continue in the event of a strike and maintains that its offer is fair and balanced. Talks are expected to continue through the weekend. Let's have a quick check on the markets now, too, shall we? Where things are in the green, too. The TSX up over 100 points on this Thursday and this afternoon. Technology stocks doing well today. Base metal sector, too, also in the green, at least for now. So continuing that run. The U.S. markets also, again, in the green after a tougher start. The NASDAQ now up 0.8%. S&P 500 also 0.5, looking at a couple of record highs too that we did see. The S&P and Dow continue to push above those averages and those records that we did see over the course of the day yesterday. A number of companies reporting profits that continue to increase too. That is offsetting any losses in oil that we have seen over the course of the day today. Well, a new report from the C.D. Howe Institute warns that trade uncertainty and weak productivity growth are creating uneven outcomes across regions and demographic groups. The upcoming Kuzma review adds another layer of uncertainty, with trade-exposed jobs still at risk. For more perspective on that, let's bring in Tingting Zhang, a policy analyst at the C.D. Howe Institute. Thank you for being here.
Thank you for having me.
Let's get into it too. Let's just first of all, bigger picture here, maybe too. Just talk about how resilient this labor market has been. Even beneath the headline numbers that we have seen.
Right. So overall, like 13% of total employment, that is like 2.6 million jobs, depend on U.S. demand for Canadian goods and services. And certain sectors has impact greatly by the Canadian tariffs and also Canadian tariffs. But the overall effective tariff rate is 6.3%. So that means most of the goods and services are still protected by Kuzma. And employment and both employment and labor force grow, even though at a slower rate than 2024. And employment grow across most of the sectors, mostly domestic-oriented sectors. A few sectors that more exposed to trade, like manufacturing, agricultural, experience a few net job losses. So overall, I would say Canada's labor market has been very resilient to the ongoing trade uncertainty.
Yeah, it certainly has felt that way too. But you take a closer look though to and we get into some of the demographics, some of we've documented and in particular how challenging this situation has been for young people as well. But give us a sense too of where things are uneven, where it's not affecting every industry or every sector clearly on an even scale. Break that down more for us and those that are being more highly impacted.
Okay, so for certain demographic groups like youth, they did bear disproportionately the negative impact so far. As you mentioned, the young Canadians, they experiencing a hard time to find jobs, and it takes longer, especially for recent graduates, to land their first job. Recent data shows job vacancies for entry-level jobs, those require work experience less than 1 year, decrease across all occupations. So the pool of available opportunities for new entrants simply just shrinks. And this will have a long-term impact for their earnings and also career progression. For recent immigrants and non-permanent residents, they also experience a really high unemployment rate. The overqualification rate of recent immigrants, what I mean is, those who have a bachelor degree or over, but working at jobs below this requirement, mainly like work for high school diploma required jobs. So this overqualification rate has increased last year for recent immigrants, and non-permanent residents also experience challenges finding jobs and integrate to the labor market.
I'm curious too as well. We've been keeping a close eye on Kuzma and what's happening with negotiations to for the wider ranging impacts. But when it comes to the labor market in particular, with the deadline looming of July 1st, at least to have a path forward of what's going to happen, how do you foresee that impacting some of the hiring, some of the jobs, some of these demographics that you're talking about in particular right through the labor market?
Right. So even with recent tariffs in specific, auto, lumber and aluminum, and it already had an impact for business investment, like the uncertainty looming that they are hesitant to hire or to invest and expand their businesses. And this uncertainty will grow as, the CUSMA review scheduled for July, and it will increase as the talk prolong. So it's really hard to predict what is coming. But what I can say is, so far the tariff is only for certain goods sectors, right? And most sectors are still protected by CUSMA. So if that is no longer exists, or anything change that, the more impact we will feel for other sectors, especially for the service sectors.
Mm-hmm. You talked about and clearly laying out businesses a little bit hesitant. There's a lot of uncertainty, at least for right now, to put that investment forward, whether it's jobs, whether it's in another sector, or maybe technology too as well, at least at this point too. So what are the long-term productivity risks for that if we watch this situation drag out, or if these negotiations for CUSMA or otherwise too as well, and the trade uncertainty continues for the next several months, maybe into the fall or the winter?
Well, the long-term impact is, we already have a weak labor productivity growth issue, and that's lasts for many years. And now with the growing uncertainty, and the business tend to hesitate to invest, and that will directly impact, skills development, and also they invest in capital, especially productivity enhancing technologies. And with AI and all other technologies developing fast, and that will directly impact labor productivity potential that even though we have such a high talented pool as an immigrant country, but if we cannot really use those and do not really accompany this talent with needed capital, then that really hinder our long-term living standards.
Ting-Ting Zhang, policy analyst at the C.D. Howe Institute. Appreciate your time today. Thanks so much for joining us.
Thank you for having me.
Well, coming up, Best Buy is surging after posting stronger than expected results, driven by demand for computers, mobile devices, and gaming products, despite inflation and higher gas prices. We'll break down those full results after this. Stay with us. U.S. GDP is up 1.6% in its first quarter, with real PCE up $18.1 billion U.S. for April. For more in-depth analysis, we heard from Getty Goldberg, Managing Director and Head of U.S. Rate Strategy at TD Securities.
The big takeaway here is that there was a little bit of a disappointment in terms of growth in Q1. Both on the back of a little bit slower investment and slightly slower consumer. That kind of gets us into April, where we actually saw consumer spending on the PCE data, consumer incomes actually coming in relatively weak, which is a little bit tricky because you do have a fairly robust labor market, a consumer that isn't getting a ton of income, at least according to the April data, but spending that is still relatively robust. So you're seeing a lot of a drop in savings as consumers really dip into those savings to keep that spending going. So it's a little bit of a tricky setup for the Fed, which has recently, at least according to market odds, been penciling in more rate hikes rather than rate cuts.
Yeah, it's interesting as we watch where that's going to, and I think some of the uncertainty that we've seen overall, market-wise and otherwise. But give me your sense too, in touching on the security, and we talk about that personal consumption numbers, maybe in as expected, but just dig a little deeper for us if you can into that as we watch you say dipping into savings, but just how tricky that's going to be here as we get into the next quarter and we get through the next few months.
Yeah, no, we've got a very solid labor market at the moment. It is low hire, low fire, which certainly is keeping a lot of folks on edge. The issue here is that you're not seeing significant growth in incomes, and part of that is starting to weigh a little bit on the potential for future spending. Right? If you don't have consumers who are having significant income growth, it is difficult for them to keep spending at the same rate. Now, you do have a bit of a K-shaped economy. The top echelon of consumers is spending, because they do have fairly robust gains on their equity portfolios, on their investment portfolios overall. The bottom of that K-shape is struggling, and the longer this continues, the more they dip into savings, the more unsustainable it becomes. So once we get that question to the Fed, for example, should the Fed be hiking rates from here? I think the data this morning actually pushes back on that hiking narrative, which is why you saw the odds or the market pricing for a rate hike go from about 19 basis points in 2026 to about 16 basis points. So market's still pricing it in, just not quite as much as it was even earlier this morning.
And Kevin Warsh has said, too, that he wants to kind of see a wait-and-see approach, right? Doesn't want to take any action, too quickly, at least at this point. What's your best bet? You said the market is pricing that in, at least for now, but what's our best guess, at least for now, or when we might see the Fed actually look at hiking the rate?
Right. So at TD Securities, we're not looking for the Fed to deliver any rate hikes or cuts this year. We expect them to stay largely flat. We do expect rates to kind of remain fairly steady from here. We're not really looking for them to take additional action. They are in wait and see mode. It is a tricky backdrop for Fed Chair Warsh. He was basically put into place to try to get interest rates lower. At least that was President Trump's intention. It's going to be difficult to do that as inflation stays relatively elevated. Growth is still fairly robust. I think the best case scenario is the Fed keeps rates unchanged for most of the year, and that keeps interest rates overall, including the 10-year, relatively elevated, even though we do have a little bit of a downward bias by the end of the year.
You touched on, too, especially in that K-shaped economy and the lower end of it. We know that energy prices, in particular for gas and diesel, fueled on by the war and the conflict in the Middle East, that still seemingly doesn't have to have an end. We've seen investors at a couple different points, buoyed at least a little bit by the fact that we might see some sort of agreement. But where is that factoring into all of this, too, as well? Because it does feel like that's the overlying factor that's affecting all these different parts of the market and then for the consumers as well.
Absolutely. That is still the biggest overarching factor in all of this. I think that has the biggest ability to break markets one way or the other. If you get a deal that actually reopens the Strait of Hormuz, you can see oil prices fall significantly, inflation expectations start to drop off rather quickly, and interest rates can actually go lower. And I think the market stops pricing in rate hikes. The longer this persists, the longer you get this current scenario of relatively decent growth in the economy and also high inflation and expectations that with every passing day, you're going to have trouble with higher energy prices, and that's going to keep feeding through into inflation. And you may actually need the Fed to hike rates a little bit because the economy is still strong. That's the tricky part for rates investors. So, much in as much as the macro data certainly matters, and we're watching it very closely, the bigger overarching theme for markets, whether the Fed hikes or even cuts within the next 12 months, will depend very crucially on Iran. And unfortunately, there's a lot of he said, she said type of headlines from there, where you'll see headlines, they'll be refuted later in the day. Markets are just incredibly uncertain on this kind of price action. And it's keeping a lot of investors really sitting on their hands, waiting for some sort of clarity, even though it feels like these negotiations can just continue to drag on and on and on.
Yeah, it certainly is the case, at least for right now. So, and maybe, that answers my next question. My last one before I let you go to 82 is about, your expectations for Q2, because I'm assuming there's still a lot of uncertainty. But what are we looking at here, whether it's on the inflation side, too, as well for PCE?
So inflation-wise, we are looking for further upside. You've got high energy prices. All of that is going to be passing through. What we're really watching is how much of this passes through to core services prices. That's the big one for the Fed. We know core goods are being impacted to some extent by energy prices, by tariffs as well. What we want to see is how much contagion there is into services, and that's really the big one. If there isn't massive contagion, I think that'll be encouraging. Overall, we're just looking for pass-through. We're basically trying to assess the damage from the backdrop at the moment. I don't think we're going to get surprised one way or the other. The other thing we're looking for is growth. If you see the consumer slow down materially further, it is going to be difficult for the markets to sustain that hike narrative. Because at the end of the day, the Fed also wants to respond to how the economy is doing. And if the consumer is really slowing down, it's going to be troublesome for them to actually hike rates.
Kennedy Goldberg, Managing Director and Head of U.S. Rates Strategy at TD Securities. Well, still ahead, drone stocks are surging after a report the U.S. government may step in to boost domestic production. We're going to get more on that after the break. Canada's Minister for U.S. Trade, Dominic LeBlanc, will be in Washington next week, only weeks ahead of the July 1st deadline to review the Canada-U.S.-Mexico trade agreement. CTV's Abigail Beeman has the latest on the talks.
Canada needs to hold its ground.
The former chief negotiator for the Canada-U.S.-Mexico trade deal told a Senate committee he thinks pressure on the U.S. to come to a resolution will only increase. Steve Verhoeven believes American irritants like supply-managed dairy and provinces banning liquor can be solved long-term, but not as a down payment up front. He calls autos one of the biggest challenges.
The U.S. has been taking a much more aggressive position on cars this time. And I think that this is something that Canada has to push back hard on.
Canada-U.S. Trade Minister Dominic LeBlanc tells CTV News he will head to Washington next week and says Monday he met with U.S. Trade Representative Jamieson Greer for an hour via video, joined by the current chief trade negotiator. LeBlanc feels there's too much attention on Mexico's trade talks relative to Canada. But the U.S. announced it's kicking off a first round of negotiations with Mexico this week, with no mention of Canada.
I'm hearing from contacts in Mexico that things are not going quite as quickly as the U.S. is portraying it.
Other trade experts told senators it's risky for Canada not to be included.
There's a real danger that if Canada is not present, we will just be handed a list of previously negotiated items and we'll be told sign here or don't.
John Weeks was Canada's top negotiator for the original NAFTA and says his team faced something similar on automobile rules of origin.
It was a hard slog to salvage the situation. Canada should seek to be involved in any such technical discussions.
Of course, all this comes against the backdrop of the July 1st deadline for a review of the Canada-U.S.-Mexico free trade deal.
CTV's Abigail Beeman reporting. Well, shares of several drone makers and suppliers are rallying after reports the Trump administration is exploring funding deals to grow U.S. manufacturing and cut costs. The potential support could signal stronger demand ahead as military spending shifts toward lower-cost unmanned systems. For more on this, we're joined by Arvelise Bonilla-Ramos from Bloomberg News. So, Arvelise, take us through how significant this would be if the U.S. government funding does come through for these companies.
Oh, I cannot hear you.
Arvelise, you got us here?
Sorry,
no,
can I hear you?
I think we've lost Arvelise. So again, we'll hopefully get back to that story here coming up in a little bit. But for now, let's move on to the Montreal Canadiens fans who are snapping up team merchandise and game pucks ahead of a Game 5 against their Hurricanes. In particular, those pucks, they have a special meaning because they are made in Quebec. CTV's Geneviève Beauchemin has more.
It's game on for NHL playoff puck production. A sport of its own, really. Thousands of logo-printed pucks have to quickly roll off the line here in Glasgow with each new playoff round. All the team's pucks are decorated here, but the hottest items, those adorned with the cherished C, says CEO Anita Chande.
We're sending just to the Canadians about 3,000 for each game. But don't forget, there's retailers all across the country right now that want a piece of this.
There's warm-up and souvenir pucks, but in Glasgow also makes official game pucks.
They're similar to the other ones, except here is where you have the sensors.
Made in Canada, logo printed in these old army barracks in Quebec's eastern townships for all 32 NHL teams, but also the PWHL. These are champions pucks for the victorious Montreal Victoire.
Fans are buying merchandise, so we have a lot of products going out this week.
Local production, she says, helps in Glasgow react quickly when teams win or lose. The company has also scored deals for a wide range of logo-printed merchandise for several other leagues and has a busy summer ahead with FIFA and the Blue Jays' 50th anniversary. The company, too, is half a century old.
It's basically like the unknown secret of Quebec.
It was started by Jason Drolet's grandfather and started out making hockey sticks.
My grandfather founded Sherwood also as the first company, which we are in the building, Sherwood building.
It's history woven into the fabric of Canada's game. And while it says it treasures its relationships with all teams, Well, there's a special connection to the Habs.
I have heard that there's a few kisses and good wishes going with every puck that's going into the Bell Center.
And soon the company will be fabricating the Champions pucks with whatever logo may be on them. Geneviève Beauchemin, CTV News, Sherbrooke, Quebec.
Let's have a quick check, too, on the markets before we wrap things up, where things, again, are looking in the green. The TSX up big today. Technology stocks and otherwise pushing up. S&P and the NASDAQ, a lot of the markets south of the border, also still pushing to record highs based on some profits that continue to roll in and exceed expectations. That wraps up this edition of Trading Day. Thanks for being here. We'll see you tomorrow.